Ever wondered what's the difference between fundamental and technical analysis in stock markets? Today, we're going to explore these two pivotal concepts that shape the strategies of investors worldwide. We will discuss what they are, their advantages and disadvantages, and why they are vital tools in the realm of stock investing. Whether you're a newbie or a seasoned investor, understanding these concepts can make a world of difference. Stick around as we delve into the world of stock market analysis. First off, let's shine a light on fundamental analysis. Think of it as peering under the hood of a car to understand what makes it run, or better yet, what could potentially cause it to break down. It's a method used by investors to gauge the intrinsic value of a company's stock by examining related economic and financial factors. Let's break it down. Fundamental analysis entails a deep dive into a company's financials. This includes income statements, balance sheets, and cash flow statements. By scrutinizing these documents, investors can assess a company's profitability, debt levels, and overall financial health. But that's not all. A fundamental analyst also evaluates a company's position within its industry. They look at factors like the company's market share, its competitiveness, and the overall health of the industry itself. These elements can give insight into the company's potential for growth and its resilience in the face of industry shifts. And the analysis doesn't stop there. It also takes into account wider market conditions. This includes everything from the state of the economy to regulatory changes and even geopolitical events. All these factors have the potential to impact a company's performance and therefore the value of its stock. The ultimate goal of fundamental analysis is to produce a quantitative estimate of the company's intrinsic value. This estimate can then be compared to the current market price of the stock. If the intrinsic value is higher than the market price, the stock is considered undervalued and could be a good buy. On the other hand, if the market price is higher than the intrinsic value, the stock might be overvalued, and it may be wise to sell or avoid it. So, in a nutshell, fundamental analysis is all about understanding a company from the inside out. It's about digging deep, peeling back the layers, and uncovering the real value of a company's stock. It's not just about the numbers, but about the story those numbers tell about the company's past, present, and most importantly, its future. Now that we understand what fundamental analysis is, let's look at its pros and cons. Firstly, the benefits. Fundamental analysis is a trusted companion for long-term investors. It digs deep into a company's financials, providing a comprehensive picture of its overall health. It helps investors to understand the intrinsic value of a stock, allowing them to make informed decisions based on solid financial data and indicators. This method tends to favor investors who are in for the long haul, offering potentially stable returns over time. However, it's not without its drawbacks. Fundamental analysis can be time-consuming, requiring a deep dive into financial statements, industry trends, and even global economic factors. Moreover, it requires a substantial understanding of financial concepts and terminologies. This could be overwhelming for novice investors who are still getting their feet wet in the world of stock investing. Despite its drawbacks, fundamental analysis remains a crucial tool for long-term investors. Moving on, let's unpack the concept of technical analysis. Imagine for a moment that you're a historian, meticulously studying the past to predict the future. Well, that's a bit like what technical analysis is all about. But instead of ancient civilizations or world wars, you're looking at past market data. The two main characters in this historical drama are price and volume. Technical analysis is all about reading the story these two characters tell through their dance on the charts. It's like deciphering a secret language of peaks, valleys, trends, and patterns. The goal is to predict future market trends based on what has happened before. Because if history has taught us anything, it's that it often repeats itself. Now you might wonder, how does it help in predicting future market trends? Well, think of it like weather forecasting. Meteorologists study previous weather patterns to predict if it's going to rain tomorrow or if we'll have sunshine. Similarly, technical analysts use statistical figures and chart patterns to forecast price movements. For instance, they might observe that every time the price of a particular stock reaches a certain high, it tends to fall, indicating a resistance level. Or they might notice that a stock tends to bounce back after dropping to a specific price point, suggesting a support level. By identifying these patterns, technical analysts can make informed predictions about where the price might go next. They might not always get it right, just like the weather forecast, but it can give them an edge in making investment decisions. Also, it's important to note that while technical analysis is often used in short-term trading, it can also be applied in a longer-term context. The key is to understand the underlying patterns and trends regardless of the time frame. To sum it up, technical analysis focuses on charts and trends to forecast future price movements. It's like being a detective, piecing together clues from the past to solve the mystery of what might happen in the future. And who doesn't love a good mystery, right? Understanding technical analysis is one thing, knowing its strengths and weaknesses is another. Let's dive right into it. One of the strongest advantages of technical analysis is its applicability to short-term trading. It's like having a magnifying glass that lets you zoom in and spot potential profit opportunities in the short run. This is perfect for day traders and swing traders who are always on the lookout for quick gains. Another significant advantage is that technical analysis can be used in any market condition, be it bullish, bearish, or sideways. It's like an all-weather gear that keeps you prepared for all market scenarios. However, technical analysis does have its drawbacks. It heavily relies on chart patterns. This means if a pattern fails to form, it could lead to inaccurate predictions. Moreover, there's the risk of self-fulfilling prophecies. When too many traders spot the same pattern, they could inadvertently influence the market. While not without its pitfalls, technical analysis is an indispensable tool for short-term traders. Both fundamental and technical analysis have their places in the world of stock investing. We've delved into the depths of fundamental analysis, understanding its focus on intrinsic value, and weighed its pros and cons. We've also navigated through the intricate patterns of technical analysis, appreciating its emphasis on market trends, while also acknowledging its limitations. Each offers unique perspectives and tools for making informed investment decisions. Ultimately, the choice between fundamental and technical analysis boils down to your investment goals and personal preferences.